So the only real kind of question today was, would it be 0.25% or would it be 0.5%? They went with 0.25%. Can you tell from reading the notes and listening to the Fed Chair Jerome Powell whether serious consideration was given to a 0.5-point cut today?
I think they probably politely listened to Stephen Moran as far as his argument for why they should go by 50 basis points and probably just move to the next person. So I don't think that they actually gave it a lot of consideration, mostly because if they had, I suspect that we would have seen like Governor Waller, he maybe would have dissented, or the messaging coming from Powell would have been a little bit clearer that, some consideration was given, there's some back and forth, but when somebody asked him about it, he's like, nope, and let's move on.
I'm hearing from Gen Z all the way up to Boomer, every generation kind of disappointed that the interest rate wasn't slashed more.
And I understand why. Everybody who has debt, they would rather see that debt servicing cost, which is tied to the interest rate, come down lower. And when you look at some of the data out there, think about a credit card. The average interest rate that people are paying is 22.25%. That is
disgusting.
Very high. Mm-hmm. Yeah. And so by the Fed cutting by 25 basis points, 0.25%, that might go from 22.25 down to 22%. Is that really a lot of relief? And then when we look at mortgage rates, right now, the nationwide average on a 30-year fixed is about 6.4%. That might not move all that much immediately. It could take a sequence, almost like an accumulation of cuts before you see that rate come lower.
And they bake it in, Brian, right? I mean, it had already gone down. The past 2 weeks, the base mortgage rate had been dropping. Was that in anticipation of what happened today?
Yeah, I think so. And in fact, we can see that with the Treasury market. We saw that initially the excitement over the Fed cutting rates, the yield on a 10-year Treasury went down below 4%, but then it actually ended up higher on the day. And something similar, I think, was with mortgages. When we look back at the nationwide average, it was at about 7% back in May and has been gradually drifting lower. Now, the key thing is, last year, when the Fed cut, we saw mortgage rates go up. Hopefully we won't see the same thing this time.
What does your gut tell you? Is that possible? What dynamic was in play then, and is it different now?
I think that the biggest difference is that there's a little bit more confidence that any sort of inflation that we might get could be just with goods prices adjusting to tariffs, not affecting or infecting service prices. And plus, last year, there was all that debacle around the Treasury Secretary really announcing that so this was with Treasury Secretary Yellen, about leaning on issuing more debt, longer-term debt. And so that's what caused a lot of that chaos last year. We don't have that this time.
I was talking to somebody else and they were talking about, why aren't interest rates lower? Because we're past the pandemic, we're past everything. Let's get things revved up. And President Trump is, trying to influence that where there's some ethical issues with that. So what do you see happening next month and the month after that?
Sure. I think that over the next few months, we will likely see the Federal Reserve continue to lower rates. Right now, they're penciling in 2 additional cuts, so taking their target rate down to something between 3.5 and 3.75%. And we could see longer-term rates drifting lower as well. I think that one of the problems is that we really became accustomed coming out of the global financial crisis of just zero interest rates on cash. And then that was like this gravitational pull or an anchor for all other interest rates to stay low. We no longer have that anchor. And maybe that's a good thing, because look at all the distortions that very low interest rate policy caused. I mean, that can cause all sorts of issues as far as related to the dollar, investment in projects that aren't necessarily all that economical to do on their own merits. So I don't expect that we're going to go back to where we were during the post-global financial crisis and pre-COVID. It might be more like what prevailed during 2004 to 2006, which was pretty close to where we are here, maybe a full percentage point lower, but not much more than that.
Brian Jacobsen, Annex Wealth Management, is with us. So good news today if you have credit card debt or you have a home equity line or those sort of things. Not great if you have a lot of money in a conventional savings account. How are savings accounts and those sort of vehicles impacted by news like we had today?
Yeah, that's the really interesting part, is that those are very quick to respond to changes in Fed policy, whereas when you borrow money, that doesn't respond quite as much, especially if they're cutting rates. If they're hiking rates, what you borrow at, that can move up pretty quickly. So there's what we call this asymmetry between how savings rates move and bond rates, and depends upon whether they're hiking or cutting. So what I would expect is that by tomorrow, you'll probably see some of those billboards where they say what the savings rate is at various banks or certificates of deposits. Those will probably reflect this lower rate almost immediately if they haven't done it already.
Why did the markets end up mixed today? And I know that's not an easy question to answer, but earlier this week when it seemed that there was a chance for 0.5%, the markets roared a couple of days. And now today the Dow's up, but the other two major indices are down on the day. Evaluate what happened with the markets today.
Yeah, so this is what's really interesting. With that expectation that maybe, possibly, even if it's a low probability that they can do the 50 basis points, if all of a sudden the reality is different, well, those people who were banking on that bigger cut, all of a sudden they're going to cut their losses, and they're the ones who start to sell. And so even though the consensus or the average was expecting 25 basis points, that doesn't mean everybody was. And so when you have that type of pattern, the people who realize that they made the wrong bet, they're the ones who are liquidating their positions or moving to something else. So that was part of it. And also, to be honest, Powell came across as a bit of a party pooper, right? When you listen to his press conference, what he was saying, he was almost kind of leaning against some of the what you could call dovishness in the statement that, labor market has weakened a little bit, that inflation, it hasn't quite skyrocketed like they were fearing. That came across as initially dovish, but then it was during the press conference as he was talking that the market started to have that opposite reaction, because I think he was really trying to lean against that.
Yeah, I just wish he didn't talk as much. It seems like almost every time he does, the market reacts negatively. I know that's an oversimplification.
There's an argument for that, is maybe they're too transparent.
Yeah, sometimes. We appreciate your expertise. You always break it down in a way that's really easy to understand. Annex Wealth Management Chief Economist Brian Jacobsen. Brian, thank you. We appreciate it.
Thank you so much.
Check out annexwealth.com. Fee only fiduciary all the time. Go there, hit the Get Started button today.